Right now, 3 million unsold cars are sitting idle on dealership lots across the country. That's a massive 120% increase in unused inventory since 2023. Basic market economics dictates that when supply overflows to this degree, sellers have to heavily discount their products just to clear the lots. This chart illustrates the central paradox. While inventory volume surges upward, average monthly car payments skyrocket alongside it, hitting $742. 1 in 6 buyers now pays over $1,000 a month. Hitting this red ceiling triggers a wave of denials. Half of applicants are flat out rejected. Normal supply and demand dynamics have essentially broken down. Buyers are completely priced out, and dealerships are stuck paying to store millions of vehicles, creating a multi-billion-dollar standoff. To understand how we reached this deadlock, we have to trace the issue back to a highly unnatural market anomaly between 2021 and 2023. The first catalyst was a flood of government stimulus checks. This injected a sudden, massive wave of purchasing power directly into consumer bank accounts. Right as consumer demand peaked, the global supply chain stalled. Automakers couldn't secure enough semiconductor chips, forcing a severe cut in vehicle production worldwide. High cash reserves chasing low inventory resulted in extreme dealer markups. Desperate buyers were suddenly paying $83,000 for Ford Broncos that had a sticker price of just $38,000. This chart tracks a single vehicle over time to show exactly how those buyers are trapped today. The blue line represents their loan balance, which stays high because they financed at the peak. The red line is the actual car value, which plummets as the market cools. This creates a paralyzing condition called negative equity. That widening gap leaves the owner owing more than the car is worth. Right now, 1 in 4 vehicle trade-ins carries negative equity, frequently leaving buyers underwater by $10,000 or more. Trading up or refinancing isn't a viable escape route either. Interest rates for new cars have jumped past 6%, and the cost of auto insurance has spiked by 50% over the last few years. Collectively, consumers are pinned under a $1.7 trillion mountain of auto debt. The financial capacity to purchase the cars currently sitting on dealer lots simply does not exist. Because consumers are financially paralyzed, that massive inventory logjam is backing up all the way to the factory floor. The industry measures this using a metric called days of supply. In 2022, manufacturers had fewer than 20 days of inventory on hand. Today, many are suffocating under more than 90 days of unsold cars. The financial impact of storing all that dead weight is devastating, and Nissan is flashing the brightest warning signal for the legacy automakers. Nissan recently reported a 90% freefall in profits. To stop the bleeding, they eliminated 9,000 global jobs and desperately attempted a merger with Honda, a lifeline that recently collapsed. Nissan's crisis exposes a harsh reality for the entire sector. Automakers spent billions building a massive production pipeline for a free-spending pandemic-era consumer demographic that has completely vanished. To survive this standoff, manufacturers must eventually do the one thing they've been avoiding: aggressively slash their prices down to fair market value. But a massive economic wildcard is threatening to derail that necessary price correction. The Trump administration recently announced 25% tariffs on imported vehicles and parts. The immediate projections are stark. A blanket 25% tariff could wipe out 74% of U.S. auto imports, forcing manufacturers to hike retail prices to cover the difference. Some brands, like Ferrari, have already announced 10% price hikes for the U.S. market. For an industry already suffocating from a lack of consumer affordability, artificially raising prices acts as a death sentence for sales. With inventory overflowing and tariffs scrambling the math, the current economic environment is highly volatile. Traditional financial forecasting for the car market is completely unreliable right now. If you are carrying negative equity on your current vehicle, do not trade it in. Rolling an underwater loan into a new, higher interest vehicle will only dig you into a much deeper financial hole. The primary survival strategy is simple: hold on to the vehicle you already have. Focus your budget entirely on making consistent payments to drive down your existing loan balance. Surviving a $1.7 trillion economic hangover requires refusing to take on new debt. By sitting on the sidelines, you can wait out the storm until this paralyzed market is finally forced to reset.